You know that feeling, right? You've been watching your mutual fund portfolio grow for a few years, you finally go to hit that sell button, and suddenly you're completely frozen by one terrifying question. Wait, how much tax am I going to have to pay on this? Or maybe you've just stared at a statement full of jargon like short-term capital gains, indexation, and dividend tax and felt completely overwhelmed. Well, if that's you, you are definitely not alone.
Let's picture two investors for a second. We'll call them Investor A and Investor B. Both of them are great at picking funds, and both actually pull in a solid 15% return. But when it's all said and done, Investor A walks away with way more actual cash in their pocket. Why? Because Investor A actually understood the tax rules and planned their withdrawals, while Investor B just kind of ignored them. Seriously, understanding taxation is the invisible shield that protects the wealth you've worked so hard to build.
So, welcome to today's Explainer. Today, we are completely demystifying the 2026 Indian mutual fund tax rules. We're going to cut through the jargon, look at some real-world math, and figure out exactly how to stop leaving your hard-earned money on the table.
Here is our quick roadmap for today. We'll start with fund types and capital gains, move into equity, debt, and hybrid funds, tackle the notorious SIP rule, talk about dividends, and wrap it all up with some actionable tax-saving tips.
Okay, let's dive right into Section 1, Fund Types and Capital Gains.
Before we even talk about taxes, you have to know that everything basically hinges on three main buckets. First, you've got equity mutual funds which mostly invest in stocks. Think large cap, mid cap, flexi cap, and yes, even your tax-saving ELSS funds live in this bucket. Then you have debt mutual funds, dealing with government securities and corporate bonds. And finally, hybrid mutual funds, which are just a mix of both. The way the government taxes you depends entirely on which of these buckets your money is sitting in.
Now, here is a super crucial detail, and honestly a big relief. The government doesn't tax your entire investment amount. They literally only tax the profit. That's your capital gain. It's just your final selling price minus whatever you originally paid. Let's put some quick numbers to that. Say you invest 1 lakh rupees, and over a couple of years, it grows to 1.4 lakh rupees. Your capital gain there is exactly 40,000 rupees. It's only that $40,000 chunk that's actually on the hook for taxes, not the original 1 lakh rupees you started with. Keep that simple math in the back of your head as we keep going. Moving right along to Section 2, let's talk about the big one, tax on equity funds.
With equity, time literally changes everything. If you sell an equity fund before holding it for 12 months, you're hit with a short-term capital gain, or STCG. The current rule for that is a pretty punishing 20% tax, plus any cess. But, and this is a huge but, if you hold that exact same investment for more than 12 months, it flips to a long-term capital gain. And here's the kicker. Under the current rules, your first 1.25 lakh of long-term gains in a single financial year is completely tax-free, zero. Anything above that 1.25 lakh mark is taxed at just 12.5% without indexation. That is a massive, massive incentive to just sit tight and hold your equity for over a year.
All right, let's shift gears to Section 3, tax on debt and hybrid funds.
Now, debt fund investors face a somewhat harsher reality these days. For debt-oriented funds that don't qualify as equity, capital gains are generally just taxed straight according to your personal income tax slab. And that's regardless of how long you hold them. No special long-term discount here. If you're in the 30% tax bracket and you make a 1 lakh rupee gain, well, that gain is getting taxed at 30%. It's that simple and kind of brutal.
Hybrid funds, on the other hand, are definitely not one size fits all. The way they get taxed depends strictly on their equity exposure. If the fund holds enough equity to qualify as an equity fund under the tax rules, boom, you get that sweet, favorable equity taxation we just talked about. If it doesn't, it might get slapped with the non-equity tax rules. So, rule of thumb, always double-check a hybrid fund's specific classification before you put your money in.
Which brings us to Section 4, and honestly, the most misunderstood part of all this, the SIP rule.
Get ready for a massive aha moment. When you invest via SIP, every single monthly installment is treated by the taxman as a completely separate investment. Every single one. This is exactly why those capital gains statements your broker sends you are always like 3 pages long.
Let's visualize this. Say you invest 10,000 rupees every month for 2 solid years, and then you decide, okay, I'm going to redeem the whole thing today. Well, by month 24, your very first SIP for month 1 is over a year old, right? So that specific chunk qualifies for the lower 12.5% long-term rate. Same for the month 2 installment. But all those recent SIPs, the ones from months 13 through 24, they haven't hit that 1-year mark yet. Those are going to get slammed with the 20% short-term tax rate. Just remember, each and every installment has its own unique birth date and holding period.
Okay, quick pivot to Section 5, dividends.
It actually used to be that mutual fund dividends were entirely tax-free in your hands. Ah, the good old days. But under the current rules, any dividends you get are just added straight to your total taxable income. They're taxed at whatever your regular income slab rate is. So again, if you're in that 30% bracket, you're effectively paying 30% on those dividends. Definitely something you want to keep in mind when you're choosing between the growth and dividend payout options of a fund.
Now for the payoff. Section 6, tax-saving tips. Let's talk strategy.
Here are some rapid-fire ways to actually minimize your tax burden legally. First up, hold your equity funds for more than a year to unlock that much cheaper long-term rate. Second, be strategic with that 1.25 lakh rupee annual tax-free window. If you have massive gains, maybe spread your redemptions out across a couple of different financial years. Third, stop frequent trading. Every single time you sell, it's a taxable event. Fourth, if you need Section 80C deductions, utilize ELSS funds. But remember, they come with a strict 3-year lock-in. And finally, just plan your withdrawals over time so you don't accidentally spike your taxable income all in one go.
On the flip side, here are the rookie mistakes you absolutely need to avoid. Don't panic sell equity before the 1-year mark unless you absolutely have to. Please stop ignoring taxes when you calculate your real returns. Don't fall into the trap of thinking all your SIPs mature on the exact same day. Don't mix up dividend taxes with capital gains taxes. They're totally different beasts now. And for the love of all things finance, do not file your tax returns without downloading your actual, detailed capital gains statement from your broker first. But look, at the end of the day, while being tax efficient is super important, you always want to focus on your actual financial goals first. Don't make huge investment decisions solely just to avoid paying a little tax. You know the old saying, don't let the tax tail wag the investment dog. Make the smart choices for your wealth, and then just use the rules we talked about today to make those choices as efficient as humanly possible. Taxation can feel like a giant puzzle at first glance, but once you break it down visually like this, it really starts to click. So I'm curious, now that we've mapped this all out, which mutual fund tax rule still kind of confuses you the most? Is it the SIP math, or maybe the hybrid fund classifications? Drop your biggest hurdles in the comments, and we will definitely use them to shape our next explainer. Thanks so much for joining me today, and keep learning.